From the New York Times, according to the conclusions of a federal inquiry, the 2008 financial crisis was a, quote, avoidable disaster caused by widespread failures in government regulation, corporate mismanagement, and heedless risk-taking by Wall Street. The commission that investigated the crisis casts a wide net of blame, faulting two administrations, the Federal Reserve and other regulators, for permitting a calamitous concoction, shoddy mortgage lending, the excessive packaging and sale of loans to investors, and risky bets on securities backed by the loans.
This financial crisis could have been avoided. Let us be clear. This calamity was the result of human action, inaction, and misjudgment, not of Mother Nature or computer models gone haywire. The captains of finance and the public stewards of our financial system ignored warnings and importantly failed to question, to understand, and to manage the evolving risks in a financial system that's so essential to the well-being of our country. Theirs was a big miss, not a stumble.
The panel wrote, quote, "The greatest tragedy would be to accept the refrain that no one could have seen this coming, and thus nothing could have been done. If we accept this notion, it will happen again." While the panel, the Financial Crisis Inquiry Commission, accuses several financial institutions of greed, ineptitude, or both, some of its gravest conclusions concerned government failings with embarrassing implications for both parties.
And unquestionably, in our minds, there were actions that could have been taken by regulators that would have forestalled or mitigated the impact of this crisis. The Federal Reserve was clearly the steward of lending standards in this country. They chose not to act. The Federal Reserve Bank of New York certainly could have reined in what was being done in some of the large money center banks in New York. I mean, on and on and on. Regulator after regulator, they either chose not to act or turned a blind eye to what was actually going on.
The majority report finds fault with two Fed chairmen, Alan Greenspan, who led the central bank as the housing bubble expanded, and his successor, Ben Bernanke, who did not foresee the crisis but played a crucial role in the response. It criticizes Greenspan for advocating deregulation and cites a, quote, pivotal failure to stem the flow of toxic mortgages under his leadership as a prime example of negligence. It also criticizes the Bush administration's inconsistent response to the crisis, allowing some banks to collapse while bailing out others. Democrats also come under fire. The decision in 2000 to shield the exotic financial instruments known as over-the-counter derivatives from regulation made during the last year of President Bill Clinton's term is called a key turning point in the march toward the financial crisis. The report does knock down, at least partly, several early theories for the financial crisis. It says the low interest rates brought about by the Fed after the 2001 recession, Fannie Mae and Freddie Mac, the mortgage finance giants, and the aggressive homeownership goals set by the government as part of a philosophy of opportunity were not major culprits. And the panel warns that the situation is even worse today.
Our financial system is really not very different today in 2011 than it was in the run-up to this crisis in 2006 and 2007. In fact, the concentration of financial assets in the largest commercial and investment banks is really significantly higher today than it was in the run-up to the crisis as a result of the evisceration of certain of the institutions and the consolidation and merger of others into larger institutions.